We have with us James Glassman, Managing Director and Head of Economist for JP Chase. James, thanks so much for joining in. While on one hand, of course, we did have the U.S. equity markets celebrating of sorts on this new dot plot by the Fed and the fact that he has more or less turned dovish. How much do you think does this also point to a worry that the Fed has when it comes to whether global growth or growth in the U.S. economy? Because even the jobs data, which we did have from the U.S. economy, was not all that great.
Yeah, it's hard to know exactly. I don't think that the worries about the slowdown in the U.S. are that big of an issue for the Fed because labor markets are very tight. So I think the Fed actually would not mind seeing things slow down. I think the bigger issue is that they have decided that they can be more patient. Inflation has not really played out the way they thought it would. And I think they're much more comfortable that they've got the interest rate policies closer to where they think is normal. So it's hard to tell exactly what all the pieces are that play into this. But frankly, I don't know why people were so surprised about what happened yesterday, because the Fed has been telling you the script really since the turn of the year. They've been telling you there was no reason to change interest rates anyway, and they've become much more patient, and they're much more tolerant about the worry about inflation. So I think, if they were worried about the downside, I think you would hear more about that. I think with the labor market doing what it's doing, I don't think that is the number one worry at the Fed. I just think they've become much more relaxed about the way they manage the cycle when inflation is not really turning out to be anywhere near the problem that many economists thought you would see when the economy gets back to a fully employed state. So it's a more relaxed Fed, helpful, I think, for risk markets, and very positive. At the end of the day, though, it's not really about the central banks. It's really more about the inflation dynamic. If inflation is an issue, central banks have to step in. If it's not an issue, they can be relaxed. And I think that's where we are with the developed economies. And that means that we still have room to run. And I think it gives the global economy breathing room to sort of pick up speed again. And, following a year that was sort of disappointing last year.
James, the U.S. economy is unlikely to enjoy the kind of sugar rush which it has enjoyed for better part of 2018, largely because of tax cut. Do you think that is something which Fed could go wrong in their assessments? The expansion may not be all that great?
I don't think we need that kind of rush is the problem. When you listen to the worries in the U.S., it's all about we have more than 7 million jobs businesses can't fill. And the problem is the unemployment is very low. So I think the Fed is much more comfortable with the idea that maybe this sugar rush is behind us. And even if the economy slows down, which everybody's forecasting, I don't think they see that as a problem for the U.S. economy.
James, what about, what you believe that this, this Fed's big shift, do you think that this could perhaps even have room to help tighten the way for Asia's central banks, open the door for further easing there?
It could, because the U.S. is kind of on the leading edge of the recovery from the global recession. So I think the thing that will guide most of the central banks is if inflation isn't turning out to be near the threat that they thought, well, maybe there's no need to be as tight as they had thought they might have to be. And I think that was the big change in the Fed's thinking. Well, when you go back, for the last 5 years, the Fed has had this idea that unemployment is getting very low. It's below where they think is sustainable. And so when you look at their forecast, they always had this idea in there that they may have to raise interest rates to a slightly restrictive stance and then back off. I think that's what's changed. And I think that probably is not that may be a somewhat of a leading indicator of how other central banks are going to be thinking about this also.
All right, let you go on that note. Thanks very much, James, for joining in and giving us a sense as to what you made of Fed's dovish stance this time around in the FOMC policy meet.